Yo, what's going on everybody? My name is Ryan, I'm a CPA, and today we're going to be talking about selling your residential property, selling your home. We're going to talk about capital gains tax, whether you do have to pay it or not, and all that crap, all right? But first, I would really appreciate it if you would please hit the subscribe button if you're new here, and give this video a like if you will find it helpful, which hopefully you will. And also leave me some comments and questions down below if you have any comments, concerns, questions, and I will try to do my best to answer them for you. All right, so today, capital gains on selling your home. So your house is a capital asset in the eyes of the IRS. And usually if you sell an asset that has appreciated in value, kind of like stocks or jewelry or something, then typically you would pay capital gains tax on it. And it's either long-term or short-term, depending on how long you've held the assets. But with your primary home, there's, things are done a little differently because it is your primary home. There is an exclusion out there that may allow you to exclude a lot of your capital gains. And so we're going to talk about all this stuff today. All right, so first I'm going to talk about capital gains. And capital gains are basically something that you recognize when you sell a capital asset at a profit, which means if you buy something for one price and then down the road you sell it at a higher price, that means you have a capital gains most likely. Capital gains are imposed on capital assets, which are things like real estate, cars, jewelry, stocks, bonds, those kinds of things. Things that are kind of like long-term assets. So yeah, that means if you sell, vehicles for a profit, then you likely would have to pay capital gains tax on it. And so you're saying, wait, are you saying that I have to pay taxes when I sell my car? Well, most likely not, because remember, like I said, it's if you sell it for a higher price than you purchased it for. And probably over 95% of the cars on the market depreciate in value over time. So you buy a car for 30 grand, you sell it for 20 grand, that means you did not profit from it. Whatever amount you had left on the loan, if you finance the car, that doesn't even matter. That's not even a thing that you need to calculate. It's just your purchase price and your selling price. So for capital gains, the basic formula is your selling price minus your purchase price, minus any expenses that you incurred on the sale, and minus any improvements that you made to the property. That's a very basic formula, okay? And this is really related to real estate because you can't really make improvements to stocks and stuff like that. So with real estate, if you follow that simple formula, you will get what your capital gain income might come out to be. Now, when it comes to your primary home, your primary residence, there's something that a little different that goes on, and that is the capital gains exclusion. This is the Section 121 exclusion on the IRS tax code, and it allows taxpayers to exclude up to $250,000 per spouse. That means if you're married, up to $500,000. If you're filing single, then it's $250,000. And there are several things that you have to meet in order to qualify for this exclusion. Now, this exclusion means that, if you take that capital gains formula I just talked about, if your capital gains was less than $250,000 and you qualified for the full exclusion, that means you technically don't pay any capital gains tax on the sale of that home, okay? And if you're married, your capital gains is less than $500,000. So I'm going to go through the eligibility requirements for this Section 121 exclusion, and then you can judge for yourself and see what it might take for you to qualify. And this could be a huge tax planning thing, for you to avoid massive capital gains tax, since we all know the real estate market is kind of bananas right now. So you buy a home a year later, it's probably worth $100,000 to $200,000 more than you purchased it. Planning around meeting these eligibility requirements could save you a lot of money in taxes. So the first thing you have to consider is, did you acquire the property in a 1031 exchange in the last 5 years? If you don't know what a 1031 exchange is, then this probably doesn't apply to you. So if you did acquire this property in a 1031 exchange in the last 5 years, that pretty much disqualifies you from this exclusion. Okay, so that's the first test. The second test is the ownership test. Have you owned this property for at least 2 years of the last 5 years? Okay, that Simple test there. Have you owned the property for at least 2 years? If the answer is yes, then you meet the second test. The third test is a residence test. Have you lived in this property for at least 2 years out of the last 5 years? Now, the residence test doesn't have to be one block or one chunk of time. You could live there for 6 months, and then maybe you move overseas for a job or something, come back, live there for another 6 months. As long as it all happens within the last 5 years, you get a total of 730 days of residence in the property, then you meet this test as well. If you're married, both spouses have to meet this residency test, okay? So, if you have a married couple, one spouse moves away for a year to do a job or something, then they technically don't live in this property anymore until they come back. While the spouse that stayed at home would meet the residence test. So that's important when you're married, that both spouses have to meet this test. For the ownership test, only one spouse has to meet that eligibility requirements. So, sometimes you have a property that's owned by just one spouse because they're the income earner and the other spouse is like a stay-at-home parent. Then, only one spouse has to meet the ownership test. The fourth test is called a look-back period. The basics of this test is to make sure you haven't taken this Section 121 exclusion in the past 2 years, because you can only take this exclusion once every 2 years. So the look-back test is just saying, hey, let's look back the past couple of years. Have you taken this specific exclusion on another home that you sold? If you have, then you might be disqualified for this exclusion this time. So basically, if you meet those criteria, then you qualify to exclude up to $250,000 of capital gains per spouse on the sale of your home. So what does that look like? That means if you for most people, like let's say you purchased a home 10 years ago for $200,000, okay? Now it's worth $700,000. Let's say that. Let's say a married couple has a $200,000 home they purchased a while ago. Now it's worth $700,000. They want to sell it. Now, if there was no commission, if there was no selling expenses considered, and if they didn't make any improvements to the property, just to make this example simple, they would have a capital gains of $500,000. 700 minus 200. And, since they've lived there as their primary home for the past 10 years and, they met all these tests, they can exclude that $500,000 gain from their taxes. So in essence, they pay zero taxes, okay? A lot of planning can go into this. If you just bought a home recently and you might want to move to a different home, maybe it's a good idea to just wait another year or whatever it might take to meet these eligibility requirements so that you don't pay a massive amount of the capital gains. Now, there are exceptions to some of these rules that could qualify you to a partial gain. Because as you know, like the residence and ownership tests basically means you have to own the property for at least 2 years in order to qualify for any of this. So if you own the property for less than 2 years and lived in there for less than 2 years, then there are some things that might allow you to qualify for some of the exclusion. But as long as you owned the property and lived in it for less than 2 years, you will not qualify for the full exclusion. So if you own the property for less than 2 years, then a work-related move might qualify you for a partial exclusion. A health or medical-related move, if you had to move for health reasons, like if you had to go take care of a family member because they became terminally ill, that would qualify as a medical-related move. For your job has to have, the job that you take or the job that you have right now that relocated you has to be over 50 miles further than your current job in order for the partial exclusion to qualify. You can't just take a job down a mile down the road and then just say like, oh, I had to move this job, to be 5 minutes closer. That doesn't work. It's got to be at least 50 miles. Okay. So work and health related moves can qualify for partial exclusions. And then the last thing are like unforeseen events or disasters or something like that. Anything that can be considered a casualty loss would qualify you for a partial exclusion. All right. So that's all I got. I know it's a very basic overview of this exclusion. If you want to learn more, check out publication 523 of the IRS tax code. I will link it in the description below. And again, if you're new here, please consider subscribing to my channel. I would really appreciate that. And again, if you found this video helpful, smash the like button, rub it, whatever you want to do with it, caress it, I don't give a shit. Do it to the like button, and I would really appreciate that as well. Yeah, that's all I got. Take care, stay safe, and I'll see you next time.
Move for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a